cover the national real estate trends for December. Joe, how are you doing this evening?
I'm doing great, Lon. Thanks for having me, man. I'm excited to get to chat with you about this stuff.
It is always great to be here. So, as always, there's a chat box on the side. So, if you've got any questions, you can just type them in here. I'll shut one there. And we'll try to address those as we go through the package here. So, don't be bashful about asking questions. And we'll be happy to send out a copy of all these slides to you as well. So, let me see if I can launch this presentation. Joe, can you see that all right?
Yes, sir. That's a good looking house you got there on the cover. I like it.
Yeah, it's a pretty fancy house. I think this one that just sold for like a record amount in Utah at one of the ski slopes there. Pretty fancy
Cool.
place. So the main goal of doing the national trends for you guys is to give you a really good data set so that when you're trying to think about real estate as the time to invest, what should I be investing in? You're not just doing it off of guts and intuition. You're kind of doing it on a factual basis. So I'll be showing you a lot of facts today. Quick note from the attorney. There's a lot of forward-looking comments in here. May, would, should expect, plan, seek, anticipate, believe. This is all based on what I've read in the papers, the analysis that we've done about the market. I own a large, or used to own, not anymore. I run a large real estate brokerage. What I see from that. Joe's observations. Joe, what do you do all day?
You know what? I just do loans and talk to people all day long, look at economic reports, look at mortgage-backed securities, look at interest rates. So nothing relevant to what we're going to talk about today.
All ties to it really closely. So
It does.
anyway, there's a lot of company sourced information just from Joe and I talking to clients and talking to sponsors, and we'll try to distill all that for you here. And nothing in tonight's presentation should be construed as an offer to invest in anything. If you'd like to invest this week, that'd be fantastic. We'll send you the materials if you're curious about that. Okay, so the main summary points here. Not a whole lot of change from last month for those of you guys who were here then. Prices were up a little bit in 23 and 24. We are getting more reports of buyers saying that they want to buy. Joe, are you hearing this anecdotally as well as you talk to clients all day?
You know what's really interesting, Alon? I'm going to do more transactions in December than I've done in like the past 4 or 5 months. So
Wow.
yes, I am seeing people getting off the fence, and not combined, right? But more in December than I did in November, October, September. So I am, yes, seeing people get off the fence. A lot of what we spoke about, 2, 3 months ago was folks are waiting for the election. I want to see what happens. That is past. It was decisive. And now we are moving on to another phase, and we are seeing people get off the fence. So yeah, I'm personally experiencing it.
Yeah, I've been through 5 or 6 cycles now for elections in my presidential elections in my real estate career. And it's always the same thing. It's an excuse not to act,
Yep.
which is really, really fascinating. There on the national polls is a little bit more indication of sellers agreeing that now is the time to sell. I heard a humorous story of a couple that got divorced, but they couldn't afford to move out from their house and buy individual houses because they had this really excellent rate. So the wife's living upstairs, the husband's living in the basement. And there's only so long you can do that where eventually like your changes in life situation overcome the inertia from having a 3% mortgage rate. So that'll continue to build over time. At least in the Denver market, there's some neighborhoods that are now a buyer's market. So what I mean by that is if you take the number of active listings, compare that to the number of homes sold in the last year, how many months would it take to sell every home in the market? And that's the months of inventory. And to me, it's the most important metric for real estate because it gives you a good handle of supply and demand. So if it's more than 6 months of inventory in a given neighborhood or a given market, there's too many listings. There's not enough buyers, and the buyer's going to be in charge of the negotiation. If you're below 4 months of inventory, there's going to be too many buyers chasing, not enough listings, and the seller's going to be in charge of the negotiation. And between 4 and 6 is kind of a balanced transaction. And Joe, usually what I'd expect to see in a buyer's market is that the buyer can ask for more concessions. The inspection notice might be a little bit more generous in the things they can get. Are you seeing this in the contracts that you're financing?
So this is a really interesting answer. Yes, I am seeing that. However, I'm also seeing some sellers that have not come to grips with reality. We had one seller just the other day that the contract terminated because the seller was not willing to repair the sewer. and it was about a $7,000 or $8,000 repair. And they said, nope, we're going to go back on the market, which made no sense to me, given that it is December and there is much less demand right now than there has been, for a long time, but the seller's behaving just as if it's 2020. So yes, I am seeing that buyers can get better deals. They can negotiate a little bit harder, but there are still going to be some sellers that have not come to grips with reality.
Yeah, and those just aren't the guys who are going to sell in this market.
Yep.
So rates have improved a bit. Do you want to just kind of give like a couple high level points on rates? And of course, we'll talk about that more in a later section.
Absolutely. Yeah. Gosh, 16 months ago, rates were at 8%. Now, right around 6.6, 6.7, given the day. And, there's been a lot of speculation. Rates are going to improve. Rates are going to get worse. I do agree. Rates are likely going to improve 1/4 to maybe 0.5% over the next 12 months, up until probably fourth quarter of next year. I don't think we're going to see rates of 5%. We're certainly not going to see 3, 4%. But we have less pressure on buyers' purchasing power right now than we did a year ago or 16 months ago. So we have seen some improvement. I don't think we're going to see a party of 2, 3%, but I think we're generally becoming the new normal of 6% rates.
I think that's going to be it, unless we see that Elon Musk is able to materially cut government spending, which that'd be great. I just don't think it's likely to happen. And if the deficit hawks, part of the Republican Party, are able to influence some control over the let's cut the taxes and grow the deficit, if we can be moderate in the amount of tax cuts so that the deficit stays constant or maybe even goes down a little bit, that would probably have a favorable impact on the rates, wouldn't it, Joe?
I completely agree. You're right. If that happens.
It's a lot of ifs in one sentence.
Yeah.
So I'm expecting that you're going to see generally positive prices on homes in 25. I think your condo prices might be flat to maybe a slight bit down in 25. I think volume is going to be about the same, maybe up an itty bitty amount in 25, but not up a lot. If you're ready to move, I think you're in a pretty good position. There's definitely more negotiation room. Are you is that the vibe that you're picking up from talking to clients all day?
That's exactly what I see. And a really interesting article I read, and I unfortunately I don't have the reference, which I'm going to fail on that a couple times tonight. But 2024 was the worst year for the number of homes sold since 1995. So we
Yeah,
are literally at the very bottom over the last 30 years. I do expect there will be more transactions in 2025, but it might not be 5 million. We might move from 4.2 million to 4.3, 4.4. So I
yeah,
think transaction count is going to grow, but it might still be a tough year.
yeah. I think that's true, and I think the condo market will probably be softer than the home
Mhm.
market. I think first-time buyers, and I'd love your commentary on this. First-time buyer affordability is more of a challenge with attached product, townhomes, condos, than it probably is for detached houses, which tend to be a little bit more pricey. Are you kind of seeing that?
Exactly that. HOAs are sometimes 400, 500. I even saw one recently, $600 a month. That is making a big impact on what that first time buyer can afford for a condo or townhome. And that is exactly what you said, going to lead to flat or potentially slightly declining prices in the attached homes.
So, if you are an investor and if you can find the rare condo that cash flows, it'd be a great time to buy one. So when
Yep.
will mortgage rates come down? We discussed that we don't expect them to come down very much, maybe a quarter over the next year. What will it take for prices to come down? A little bit of softness in condo prices. Homes will probably be up a little bit. In composite, it'll be up a little. Can I find a house if I want to move? Yes, the inventories are up,
Love
which,
that one.
yeah. So if you've got a client that was looking anytime in the last 36 months, there's more inventory now. And it's going to be a lot easier to find something, even if they're kind of fussy. Now, if you compare our inventory today to pre-COVID, it's less, but it's hard for people to even remember back that far. And I think there's no chance of a market crash. We'll talk about that.
No.
So Gail said I had a condo listed since September, hoping for a contract before year end. Gosh, I mean, unless you're like the lowest priced one and it's actually a pretty good deal, it's tough. But
Yep.
historically, we see mid-January, early February is where the buyers tend to pick up in the spring season. So I wouldn't give up on it. You might just be a few months later than you. we're hoping for.
I agree.
All right, consumer confidence. After the election, uncertainty was resolved, even if you're unhappy with the outcome, and you can see that consumer confidence has improved quite a bit. Essentially, sometimes they sort this out between Republicans and Democrats, and it's always funny seeing how that changes over different presidential cycles. So the people who report they have interest in moving over the next 12 months has increased dramatically over the last year, from about 13% to about 18% of the population. But increasingly, a large number of potential movers are saying they think they'll be renting instead of buying, which was kind of a shock. And is that entirely driven by affordability and the ability to qualify, Joe? Or do you think there's other psychology there?
I really think it's definitely the affordability challenge. I do still think that owning a home is a great way to build wealth, but when you're looking at a rent and you can rent a really nice apartment for $3,000 a month, and you want to buy a condo, and with HOA dues and something similar, it's going to be $4,200 a month. Sometimes on just a monthly basis, it doesn't make sense to buy. And I hate saying that, right? Like, I'm the guy that wants to help people buy homes, but sometimes for your monthly budget, it might not make sense. Now, I do think for your long-term budget, it makes sense to own, but some people are really getting squeezed on that affordability challenge. And I think that's why we see the graph on the right-hand side increasing, because a lot of people are going to need to rent for a while.
Yeah, I think that's absolutely true. No doubt about that.
Mm-hmm.
So this is the consensus of a number of economists on the number of home sales for next year, and they're expecting that we'll see a little over a 10% increase. I'd be really happy if we had a 10% increase in volume. I think it'll be a little bit less than that.
I agree.
Do we have any statistics on sales volume and prices for off markets? James, I wish I did. There's no easy way to gather that, unfortunately, but I don't have any reason to believe that it's any better or any worse. I am part of a mastermind group of people who work in real estate as investors, most of whom do a lot of wholesaling, and their volumes are down a little, but not tremendously over the last couple of years. So if I had to guess, I would say that the number of off-market deals has probably declined at about the same percentage rate as the on-market. But Joe, do you have any insights to that?
I don't. I unfortunately don't have any statistics on that. Like you said, it's really difficult to derive that data.
Yeah, a great question. So, one struggle with renters is a lot of them are having a tough time economically. That might be leading to some of their pessimistic consumer confidence scores. If you ask about consumers, do you have any unpaid bills in the previous month? And the number of renters who said yes is more than 25%. It's a pretty high number. The number of homeowners is quite a lot less than that. So for that proportion of the renters that would ordinarily be on a glide path to being a first-time buyer, it's pretty tough to be amassing any kind of a down payment in a savings account when you can't even cover your monthly bills. Joe, are you seeing a lot of people like kind of subsidizing their lifestyle on their credit cards?
A ton. Yeah. And can you stay on that slide? I have
Yeah, of
one
course.
thing I wanted to point out. To answer your question, yes, I see a lot of folks, and I actually read a really interesting article today that 39% of renters make enough money to afford their lifestyle and are getting all of their bills paid and having positive income compared to expenses. That means that 61% of renters are having to put some money on their credit card and not pay it off every single month. That was a really, really shocking statistic when I read that.
Wow.
Yeah. I also wanted to show there's just a little bit of foreshadowing on this chart. Right in the center, the red line, you've got percentage of consumers with unpaid rent or mortgage. And that red line is a homeowner. Now that is down at 1% or even less. So if 99% of people were able to pay their mortgage last month, and only 1% of homeowners were not able to pay their mortgage, that is not a leading indicator for a foreclosure boom. And we're going to talk about this later in the presentation, but this is kind of some good foreshadowing, and I really like this slide.
It's a fabulous thing to take out of that. Hey, can you talk a little bit about the renter guideline of how much of your income you can use to qualify? Is it a third or 40% or half or?
Yeah. So, I believe the property manager that I use, it's exactly what you said. They want, let's say your income is $5,000 a month. They want your rent payment to be $2,500 or less. Now, traditionally, if you were making $5,000 a month, your rental payment should be like $1,650 or less. So we are seeing some flexibility for landlords and property managers, that you can rent a little bit of a more expensive apartment. But what that does to you is you don't have a lot of money left over. So we're seeing that people are spending a higher proportion of their income for housing. And I think that's true for homeowners as well as renters.
That's an important one right there.
Mhm.
So this chart is a little bit of a gloomy trend. It shows of the renter community, fewer people think that they're going to be able to buy over the next 3 years. But I think the thing to focus on here is that around half of the people who don't own a home want to own a home sometime in the next 3 years. So if
Mhm.
you're a realtor on this and you've got a lot of these types of people in your database, keep reinforcing all the benefits of being an owner. Keep talking to them because a lot of them eventually will turn into clients for you. Can you talk a little bit about what's going on with credit card debt? It looks like it's going up quite a bit here.
It is going up at an unprecedented rate, and that's the line here in gray. And it's currently greater than $1 trillion. And if you go back and you watch one of these that we did a year ago or 18 months ago, we were at $900 billion in credit card debt. And I said, guys, there's going to eventually become a reckoning because people are using their credit cards to subsidize their lifestyle. And that's what happens when you have inflation, and inflation is outrunning wage growth, is you either have to dial back your lifestyle or you put some of that lifestyle on your credit card. And that's exactly what we're seeing with credit card debt now at $1,073,000,000,000. That is a lot of credit card debt and is hampering a lot of younger home buyers' ability to save up and buy a home.
So, ironically, this might be the factor that eventually triggers us to have more inventory and more deals getting done in the market. So, Joe, if I've got a couple 100,000 of equity in my house, and for whatever reason, maybe my credit score is not as good or some other factor, getting a second mortgage isn't the answer. Might I refinance my primary mortgage with you just to like free up some cash out on a cash out refi and pay off that credit card?
That's exactly right. Salon, I have some clients that I see, or I guess a batch of clients that I see that are having their credit card debts continue to increase 50,000, 60, 70, some cases $100,000. And eventually they're going to get to where they can no longer add balances to their credit card debt. And we're going to have to do either a second mortgage, or more likely, we're going to have to do a new first mortgage, pay off their 3% rate, pay off $100,000 of credit card debt at 29%, consolidate all that into one loan at 6 or 6.5 or 7%, save them money on a monthly basis, but use a lot of that equity to pay off some of that credit card debt. And then guess what? A year or two down the road, it's not as difficult for them to say, hey, we want to sell our house because we want a nicer, better, newer home. And they're not stuck in that 2 or 3% mortgage rate. Now they're at 6, 6.5 or 7%. That's going to free up some of those golden handcuffs that are, causing that lock-in effect right now.
It's a very unusual backdoor way to free up more transactions, but you explained that to me the other day, and I really appreciated that a lot.
Thanks.
The Federal Reserve looks at the net worth of homeowners versus renters. Homeowners average net worth almost 400 grand versus the average renter 10,000, and that leads to this. Most Americans say that real estate is the best long-term investment. 36%, much higher than stocks or gold or savings account or cryptocurrency. So our price is going to drop. The quick answer to that is probably they're not going to drop. So we
No.
saw rates of increase for home prices in the 15 to 20% range immediately after COVID in the 21 and the first part of 22. And since then, the price has been pretty flat. I think they'll be pretty flat next year as well. But they're not going to go down. And we'll talk about the foreclosure reason in a minute because that's what causes prices to go down. If you do have a client who's interested in, is real estate a good investment over the long haul, this is the one chart I would show them. So this is from
Mhm.
1991 to current. So 30 some years of data. The average home across America tripled in value during that time period. And the three best states were Colorado, Utah, and Montana, which were up over 500%. So this is why I think a lot of people feel like real estate is the best investment, even better than the stock market, because real estate is the best investment over the long haul. You can't go wrong. I don't think the next 30 years will be quite as vigorous as what we saw here, but they'll certainly be attractive.
Something that I would be interested to compare to on this slide, Lon, is if we had another box that showed return for the S&P 500 from 1991 through
Oh,
current. I wonder where that would be, and compare that to the national average, but then also compare that to buying in Virginia or Kansas or Colorado. So that might be something to add for this slide in the future.
what I do know is that can you guys see this Excel sheet, or is it just the one
No,
screen?
we can only see the PowerPoint.
Give me 1 second. I'll just type it in here. I know that the average stock and bond portfolio over the last 50 years returned 8.1%. So if I
Mhm.
take 8.1% and I compound that for 33 years, I think that's probably not quite right. Rule 72, let's try that. Every 9 years it would double. So it's I'll have to do that later. I'm not gonna be able to do it right now, but it'd probably be very comparable, is my guess. Maybe just slightly above. But if
Yeah.
you assume the average person put 25% down and that small amount of equity captured all that gain, it'd be a lot higher. We should actually do this. That's a really good question.
Yeah.
So for those of you guys on the call who are from Colorado, we're expecting to see that the population growth rate in Colorado is going to slow down compared to what it has been historically. That's what's driven a lot of the price gains in Colorado. So I'd expect the future price gains to be a little bit less than they have been historically. It also means that the traffic will stop getting worse at quite as fast a pace. Where do people move when they move? This chart was absolutely fascinating. If you take a look at California, for example, you can see when people leave California, they just drive across the border or maybe 100 miles away
Mhm.
to like Phoenix, but they don't go very far. And Illinois, exact same thing. They drive across the border to Iowa or to Wisconsin. All these states, people don't relocate too far. It's
Mhm.
fascinating. That must have been like a lot of work to build that chart. So, what's the average home price increase going to be next year? The consensus of all these different economists, there's 16 of them here, is 3% price increase next year. That's probably not too far off the mark for the whole
Yeah,
country.
I agree.
I think we're close there. Can you talk a little bit about the national trend on the debt to income ratio? Why is that important for mortgages?
Yeah. So this kind of goes back to what we were speaking about earlier on rental cost to your income. Debt to income is the same thing where we look at how much debt do you have outgoing for credit cards, student loans, car loans, and your mortgage. And you really want to see that in an ideal scenario as a broad base of the population, 25% or below. Currently, we're up to 27%, which again goes back to people are spending a little bit more money for their debt than we would like to see as a population. Now, it's not at a crisis level, it's not at an emergency level, but this leads you to understand that homes are not as affordable as they once were. And if you go back and look at January of 2021, the national debt to income was at 13.3%. So we're seeing debts increase faster than wage growth. And a function of that is interest rates have been going up.
So there's probably not as much of ability for people to pay more for a house to drive a lot of extra gains in prices, as opposed to if you look at, let's say, 2013 when we were at the all-time low. There you could have the prices go up, and because it was so cheap to borrow, you could easily afford to pay more. It wouldn't really be that big of a deal.
Mm-hmm.
So that's the second thing that'll be a lid on price growth over the next 5 years at least. So
Yep.
James was asking about new supply coming online in 2024. Is a lot of it multifamily? The answer is yes. I've got a whole section on that. You're leading the witness, which is great. And will that impact the housing prices in 25? No, it probably won't have any impact on housing, but it's definitely going to have an impact on rentals. And I do want to share all that with you guys. So thank you for
Mm-hmm.
bringing that up. So what all this nets down to is that the number of first-time buyers is at a record low right now. It's somewhere like around 23%. You can see in 2009 we had a record high of 50% of purchases were first-time buyers. So it's been
Mm-hmm.
kind of a steady decline for a while. I do believe there's a lot of pent-up demand on the sidelines of people who would like to buy. And we talked about that earlier, where we talked about, of the renters, do you think you're going to be buying a place in the next 3 years? And it was about half. These two slides together, I think, paint a very clear picture that there's excitement about buying, and you just have to stay in touch to help people understand how they can do it.
Yep.
Are you talking to a lot of people who'd like to buy, but they're just putting it off for a while, Joe?
Yeah. I mean, I spoke with a gentleman earlier today. He really wants to buy a $500,000 home. He's got 20% down. We go through, break it all down. He can't afford a $500,000 home. He can afford about a $400,000 home. So we have to have kind of a tough conversation that, yes, you can buy, but you can't buy at exactly the level you were thinking. And that's a big part of the conversation that we have right now is we have to reframe that reality for folks that could he have bought a $500,000 home in 2020 with a 3% interest rate? Yeah,
Yep.
absolutely. At a 6.5, 7% interest rate, we have to adjust our expectations down a little bit.
So here's one last slide. This is my last one to kind of show it to you. But if you take a look at the growth in home prices, that is the blue line over the last like 50 years. And the red line shows the household income. And you can see recently home prices have really grown a lot faster than income, and the mortgage rates have gone up. Those are the root causes of our affordability problem. So ideally what would happen is over the next 5 years, home prices would go up at a very slow pace, which we think is probably likely to happen, but we'd
Mhm.
continue to see some good increases in household income. And if we can narrow the gap between those two lines, that makes affordability easier, and more people will be able to get off the sidelines and actually buy a house.
Yep.
Cool. Roxy, I see your question here. I'm going to make a note of this and give this to Nick. I actually don't have those handy. I'll have to go dig them up on a scavenger hunt, but Nick and I will find that for you. We'll get it to you tomorrow if that's okay. And that goes to Roxy. All right. Thank you for asking that. Okay. So here's inventory. You can see that our inventory now in 2024 is up 4 years in a row, but the inventory compared to pre-COVID, it's less. And we talked about that a little bit earlier. Hey, Joe, can you talk a little bit about assumable mortgages and why we're not seeing more activity on the assumables?
Yeah. Assuming a mortgage is right up there on par or maybe even a little bit worse than completing a short sale. So one of the big challenges on an assumption is number one, let's say you've got somebody who has an assumable mortgage. That's a very small percentage of the market. It's only about 15% because it has to be an FHA or a VA loan. Conventional loans are not assumable. But let's say I have an FHA loan at 3% and I bought that home 5 years ago and the value of that home has gone up by 30%. Well, if somebody wants to come in and assume that loan, the number one thing they've got to do is pay the difference between that loan balance and the new purchase price on the home. So a lot of people don't have 30 or 35% to put down. So that's your number one challenge. The number two challenge is folks say, well, can I get a second mortgage to make up that gap? And the answer to that is maybe, but you're still going to have to put down at least 20% because most second lien holders are not going to loan you more than 80% of the value when they're going behind an assumed first mortgage. So you still have to have a really large down payment. The number three challenge is existing servicers. They're not really set up to help with assumable mortgages on a grand scale. That's number one. Number two, they're not incentivized to do it. They would rather that loan pay off and there's a new loan on their books at 6.5 or 7% at a higher loan balance versus letting somebody assume that loan. So last year, I just read this the other day, there was 5,600 completed assumptions nationwide. So 5,600 assumed transactions, and there was I think it was 4.3 million sales. So that is what 0.00001% of the market. I might have one extra zero, but a very, very small segment of the market. If you want to go through that, it certainly could potentially work, but it's very, very difficult to complete those.
So, as a rule of thumb, Denver's population is about 1% of the entire US. So, whenever I hear a stat, I always just divide by 100. So, if there's 5,600 of these assumptions in America, that means there was 56 in Denver
Yep,
last year. Um, I guess I wouldn't hold my breath too much.
I agree.
So, delinquency on mortgages is very low. So, Joe sort of foreshadowed that a little while ago. And the reason why the mortgage delinquency are low is because everyone's got a lot of equity.
Yep.
Do you want to talk about the equity situation where people have like paid off their house? It's incredible.
Yeah, I love this chart on the left. You know, you look at the financial crisis there after 2008 and 9, and you see as a nation, we were upside down. There was more debt on homes in America than equity. All right. That's a scary place. And that is a foreclosure crisis. Where are we at now? There is record amounts of equity. There's more equity than we have ever had. And a couple of things. Number one, 38% of homes are owned outright with no mortgage at all. 28% of homes, 33% of homes have equity of less than 50%, and 28% of homes have equity greater than 50%. So the only folks that might ever even run into any type of foreclosure issue would be that 33%. And most of those people have at least 10, maybe 15 or 20% equity. If they fall behind on their payments, they're not going to just hand that home back to the bank. They're going to call their real estate agent and say, hey, I need you to sell this home because I need the equity and the cash in order to pay off my other debts and get a fresh start. So equity is a big, big leading indicator for foreclosures. And we're not going to see a foreclosure boom when there's this much equity in the market.
No, I just don't see any conceivable possibility of that.
Mm-hmm.
It's interesting how the number of homes without a mortgage just in 12, 14 years has gone up from 33% to 40%. Why is that?
I think there's just a lot of people that learned lessons from 2008 and said, you know what? I don't ever want to be in that situation again. I'm going to use good financial discipline and work on paying off my house, which I'm a big proponent of that. So I think it's a good thing, but it doesn't lead to options for investors when you're looking for foreclosures. There's just going to be very few of those out there.
Yeah, that makes sense. So this chart's about a week old. Do you want to talk about where rates are at and just a couple thoughts about what might happen next?
Yeah. So this is, very close to where we're at today, 6.5, 6.6% on any given day. So we are seeing on the far right-hand side of that chart that rates are trending downwards. I don't think this chart is going to completely fall off a cliff and go to 5%, 4%. We're going to kind of bounce around in that 6.5, 6.25, 6.75. There is a Federal Reserve meeting tomorrow for the short-term Fed funds rate. That doesn't directly impact mortgage rates, but there is a prediction for those short-term rates to be cut by another 0.25%, which would be good for home equity lines of credit, credit card debt, and your vehicle loans. But don't expect a huge change in long-term rates after that meeting tomorrow.
That's, I think, dead on with all that.
Mm-hmm.
Yeah, there's not a lot of expectation that rates are going to decline from Fannie, Freddie, or the Mortgage Banker Association, which is good to see. I'm trying to find a version of this chart from like before COVID and then during COVID, and then show what actually happened to show that these expert predictions of mortgage rates are not all that helpful.
They just have a magic 8 ball. I mean, they're just guessing like me and you.
Yeah, it's all the same stuff. So one chart that I think is helpful is this one. It shows you the average mortgage rate by decade, and the 50-year average is about 7.75, and we're currently at 6.5. So it feels painful relative to the great rates we had in the 2010s, but historically speaking, these rates aren't bad. And realtors sold millions and millions of homes every year, all through all those decades. Even when the rates were in the teens, we sold millions of homes a year. So it's not the end of the world. It's just a transition that we got to get through.
I agree.
This quote is great. So 1971. Do you want to do this one?
No, go ahead. But I love this one. Yeah.
The average interest rate in 1971 for a mortgage was 7%. So if you waited for the interest rates to go down, you would have waited for 22 years. And meanwhile, the value of real estate quadrupled. So, don't let the rate get in the way of, the rest of your life.
Yeah.
All right. Does the increase in rates impact the markets? A quick answer is it slows them down. So I'm not going to spend a lot of time on that. I want to talk about a few other things instead. We should talk about this, though. So the MBA is a Mortgage Banker Association. So on the left-hand side, this is the number of clients approaching someone like Joe to say, I'm thinking about buying a house. Here's my tax returns and my pay stubs and all the other stuff. Can you open up a file, see what I qualify for? And you could see that we had a good uptick in the last week, and that the number of people trying to start the mortgage process was a little bit better than it was last year. That has not happened very many times this year. So I was very encouraged to see that. And Joe, it sounds like you're seeing a lot of activity yourself with people post-election saying, I want to go out and look.
Yeah, I'm exactly experiencing that in our personal business. And, on the far right-hand side, that black line is locking the interest rate. And we're experiencing exactly what this chart shows is there's more people getting off the fence, more people locking in their interest rate, just more people doing stuff. And that's a good sign, I think.
Yeah. Overall, though, still the mortgage applications are about 40% less than the 9-year average. So there's certainly a lot of room for improvement, and it'll probably drift up a little next year.
I agree.
Do you want to talk a little bit about your refi traffic? It looks like that's been improving a little bit recently as well. Is that also a post-election sort of an effect?
That is actually two things. So folks that bought a property a year ago, 18 months ago, when they were at that 8% interest rate, we're now being able to just help some of those folks get out of that 8% interest rate. I'm closing a transaction next week. They bought 9 months ago and their rate was 7.75 at the time. We're getting them a new interest rate of 6.5% with no closing costs. So that's
Wow.
something to selfishly share with you guys, is we have our refinance special going on, that if any client that has worked with us in the past, or any client that anyone on this phone call refers over to us, they can refinance with no closing costs right now. And that's actually a really big benefit for folks that bought a year, 18 months ago, 24 months ago, when interest rates were up. So don't be afraid to have your clients reach out to at least have us just review it, because there are some opportunities to save depending on how long they've owned the home.
Would you be able to drop your name and number and email into the chat just for people who might want to take advantage of that?
Yeah, that's a great idea. Thank you.
So James was asking earlier about supply and demand. I want to talk about that for the apartment market. So absorption means that there was 1 unit of vacant apartment capacity that was taken by a new tenant. And you can see that so far in 2024, and this is only 3 quarters worth of data, we've had a gangbusters year. We're a little over 400,000 units that we've occupied that were prior vacant or we've absorbed. And that's just an absolutely fantastic number. So, why is that? Household formation's been exceptionally strong. So, what I mean by household formation is imagine that you've got like a 20-year-old kid living in the basement at their parents' house. So, that's one household. And the job market's really strong. So, the kid is able to get a job and he's got enough cash flow. He's able to afford his own house or his own apartment. We've created one household, and strong jobs and a good economy are the main thing that predict job creation, and job creation predicts more households. It works in the opposite during a recession. If you go into a tough recession, the 20-year-old might lose his job and he's got to break his lease. He's forced to move back in with his parents, and you've destroyed one household and you've created one more unit of vacant rentals. So the strong job market is the main thing that's enabling us to have a lot of new renter households get created to absorb vacant units.
Mhm.
So the other thing that's driving this is that the average household keeps getting smaller over time. There's a record number of people, according to the Census Bureau, who are one-person households. It used to be considered sort of a luxury to have your very own place, and that's not so common anymore. But enough people are affluent enough they can afford to have their own condo or their own house all by themselves with their cat. And that's driven the need to consume a lot of rental inventory. So we talked about wage growth, how wage growth has powered a lot of new households. So we've had a lot of apartments get delivered, record numbers of them, in fact. But since the demand has been just about as fast as the supply growth, we haven't had to have the concessions to incent people to move into these vacant units that you would ordinarily expect. So this slide, I think, tells a gigantic story. So we've got 3 market cycles here. So the blue line is a recession. So you remember 2007 and 8 with the great housing recession. And then more recently in 2019, we had a housing recession, or a recession in general wasn't driven by housing. So in the 2002 to 2006 range, about 41% of apartments had to offer concessions in the knife fight to get a tenant to fill a vacant unit. And you can see during the 2009 to 2019, it was only 28%, quite a reduction. using incentives, and currently it's only 15%. So while we've had a record number of apartment deliveries, we've had such great demand. The amount of discounting, and I'm going to give you a free month, or I'm going to give you a $200 Amazon card, has been a lot less than historically that we've seen. I think this chart tells you more about the state of the apartment market than just about any other chart. It's just fantastic.
Mm-hmm.
So the number of new starts is slowing down a lot. So you can see that this is the difference between the number of completions versus the number of starts. So you can see that the number of units getting completed about 2 quarters back was very large relative to the number of starts, and that is now reversed. So we're going to deliver almost 200,000 more units this quarter than we'll be starting. So the reason for this is that in 2019 through the first part of 2022, mortgage rates were ultra cheap. And banks were eager to lend. It was very easy for a developer to go to a bank and say, I want to build this apartment complex. Can you loan me 80% of the cost? And they would say, sure, here's the money, go do it. Once the interest rates started going up, which was around March of 22, the banks got a lot more careful about making loans, and development was no longer a very exciting idea for the bank. So the no's increased dramatically. And then by the time you got to late 22, mortgage rates had almost doubled. So projects that would have penciled out when I could borrow at 6% wouldn't pencil out when the mortgage rate's at 9% for a construction loan. So what we saw is that there was a record number of new projects that were conceived, financed, and launched in 2019 through the first part of 2022. And that gigantic crop of new developments has been delivering in 2023 and 2024. It takes about 2.5 years from breaking ground to getting the product on the market. Now I need all these new tenants to fill all these new units. So we're actually at the apex right now. Collectively across the US, this quarter or first quarter of next year will be the record number of new deliveries. And it may actually be an all-time record.
Mm-hmm.
But these new apartments don't just appear like a dandelion in your yard, like instantaneously. It's like a 2 or 3 year process of gestation. So I could take a look at what starts were there in 23, what starts have there been in 24, and that tells me very accurately the number of new deliveries for apartments I'll have in 25, 26, and 27. The answer is a whole lot less than I've had recently. Meanwhile, the job market has been very strong. It's remaining strong, and it's anticipated the number of households that'll be formed will continue on a pretty strong pace. So demand is going to continue to be pretty close to red hot, but the new supply growth is going to fall off a cliff pretty soon. Joe, what does that mean to vacancy rates and rents?
Vacancy rates are going to go down. Rents are going to go up. It is a great time right now, today, to buy investment properties.
Absolutely. It's an absolutely incredible time because there's a lot of investment properties that are under some distress, so you can buy at good prices.
Yep.
How will immigration impact absorption and development? It's a good question. So I think it all depends on how successful and how broad reaching it is in this effort to actually move a lot of people out. So we've had a record amount of immigration over the last couple of years. I think what's more likely to happen, and I'm not a political analyst, this is sort of me guessing and maybe Joe can answer some questions. Instead of us seeing immigration be like very, very strong, I think it's probably going to flatten out, or maybe it'll decline a little bit. So the number of new immigrants coming in, that pace of immigration, I expect is going to get tamped down a lot. But I think it's going to be very difficult to go find all these people and root them up and kick them out. I think that's going to be pretty difficult to do, particularly because most of these people have jobs that are contributing to the economy. Like if they're sitting around not working, it'd probably be a lot different mentality out there. But I don't know, Joe, what do you think?
I agree 100%. I think immigration and the flow of folks coming to the United States is going to slow, perhaps even balance out to zero. But I think it's a much bigger effort than maybe anyone grasps to really change that tide.
On one hand, we've got this big push that we're going to simplify government and reduce government payroll. And on the other hand, we're saying that we're going to go hunt down a couple million people and kick them out of the country. Well, how many tens of thousands or hundreds of thousands of federal agents would you have to do all that research, find these people, seize them, and haul them over the border? Like, you're going to have to hire and train a lot of people to do that. I just, like, who's going to do all that work? Like, it's a lot of manpower that we probably don't have.
Yeah.
So why will the starts not be rebounding anytime soon? So the number of starts right now are off about half from the high of April of 22. There's no evidence of any rebound in starts. So the leading indicators that you should be looking at are developers, architectural billing hours in multifamily, permits getting pulled, and then what are the credit conditions? Are banks willing to lend on construction? And the answer to all these is that the door is closed. We're not interested in doing this.
Yep.
Of the projects that have been approved and they've got the plans and they've got the permits, a lot of developers are intentionally delaying the starts of their project because they don't want to deliver yet. They want to see this demand continue to absorb lots of the vacant units. They want to see the vacancies go down. They want to see the rents go up. And if they wait a year or two and they deliver into a really strong market, they won't need any concessions at all. They'll just lease up the building instantly and their financials are look phenomenal. So we've seen some people do that, and I think it's a very smart strategy. The architectural billing index for multifamily is on its 20th consecutive month of decline. That's a great tell of what's going to happen next. Credit conditions are pretty tight, and yeah, I mean, the banks just aren't interested in commercial real estate development. The reason why, there's a whole bunch of factors why the banks aren't interested in commercial real estate development, but the most important is that commercial lenders have these silos of different styles of loans that they're allowed to make. So for their entire loan portfolio, their composition of their bank, they've got some formula from the regulator. Maybe they're allowed to make 18% of their loans can be in commercial real estate development. So what the bank needs is for a prior development project to complete. That project gets sold and the money is used to pay off the loan. And then the bank's got a big pot of cash and they can go make one more giant development loan. The problem that we're having is that there's all these development projects that have been completed and leased up and they're stabilized, and it's not a good time to sell the projects. So these loans are not getting paid back at nearly the pace historically that you would predict. What should be a 24 or 36-month development loan is now a 48 or 60-month loan. So even if the banks were optimistic and wanted to make development loans, they couldn't just because there's no cash to lend out. So
the money's tied up.
Yeah, the money's all tied up. So my expectation is that it's going to be easier to sell an apartment for a good price in 25 than it was in 24. 25 is going to be a great transition year, so more people will sell. 26 is going to be the year where we see lots and lots of apartment sales. And by then, the rents will probably be up a lot. The vacancy will be very low, and then we're going to see another round of development start. But that's another problem for another day. Yes, David, we will share this as a presentation with you guys. You'll all get a copy of that. So some other constraints on new construction is that labor is going to be a little bit more expensive if we're not able to import immigrants to be doing construction work for us. The cost of construction will go up. Some of our building materials are imported from China if there's a lot of tariffs. Some of the materials coming from China, like luxury vinyl tile, is a great example. I think almost all of it comes from China. Those prices will go up a little bit. It won't be significant, but it'll just be one more piece of friction that makes it tough to get things done. So here's the deliveries. You can see that 2024 estimate, we're supposed to deliver about 600,000 new apartment units. 25 will be about 500, and it falls off a cliff to about 200,000 for the next 4 years. So just like Joe said, like if you can look at investing now, and this is what we do at Ironton, obviously, is help you invest passively. It's a good time to be looking into that.
Yep.
The peak delivery quarter depends on the metro. So overall for the US, the peak is right about now. For Denver, it's going to be in the first half of 25. But for the cities in Florida, for example, South Florida, I guess it's about the same, but you can see how it varies from one place to the next. So this definitely impacts what things we invest in and what things we decide to pass on.
Mm-hmm.
And we talked extensively in the first half of our presentation about the high entry cost barrier to first-time buyers is going to lock buyers in to being renters for longer than you'd historically expect. That's just more demand for rentals. So from the landlord point of view, this is just all good news. And Joe, we talked about the high consumer debt payments. We talked about mortgages, but or I'm sorry, credit cards, but it's also student loans and car loans are not helping people save money up either. It's
Yeah,
amazing.
everybody is accruing more and more debt.
Just from 2003 to today, all this debt has gone from 7 trillion to 18 trillion. Like, that's a lot of growth.
Yeah, it's tough.
That's just insane. All right, we talked about that. So the buyers, who's going to buy all these apartment complexes? Well, they're large institutions like pension funds, insurance companies, or private equity funds like Ironton. Currently, there's $250 billion in cash sitting in savings accounts waiting to be deployed to go buy projects. Very, very exciting. So sales volumes are up a little bit this year versus last. Next year will be better. And I think that's most of what I'm going to talk about. Debt markets are getting a little bit easier. I think that's about it. So just some early tea leaves to be taken a look at here. Blackstone is a gigantic buyer of multifamily, and their CEO just said, I think this is a good time to be planting seeds. You want to be investing now because there's a lot of uncertainty. When the uncertainty passes, those investments are going to deliver accelerated returns. And Blackstone has bought a couple of billion-dollar apartment portfolios this year. So it's not they're not just saying it; they're actually doing it. JLL, Jones Lang LaSalle, very large commercial broker, reported that institutional buyer share is up 50% year over year, and a lot of these open-ended, diversified, basically, private equity funds just like us are re-entering the market looking to buy assets. I think the buyers on the institutional side are taking a look at the obvious supply crunch of very little new apartment inventory coming to market, really strong demand. There's going to be very strong rent growth again. This is probably the time to be buying, to be positioned for that. So all this points to a good 25 and a really strong 26.
Yep, I agree.
And I think that's all I wanted to cover for tonight, and it's not 7 o'clock, so we actually have time for a few more questions.
So I love this. Could the increase in consumer debt lead to a crash, or is that unlikely, given what was explained earlier about people repackaging their high-end debt? I think exactly that, James. If you've got somebody that has $100,000 of credit card debt, and I know that number sounds crazy, but I do see it. You've got somebody with $100,000 of credit card debt and $300,000 of equity in their home. They are not going to miss payments on the mortgage and let that go into foreclosure while they're continuing to pay their credit card debt. First thing they're going to do is call a guy like me and say, can I get a second mortgage? We're going to look at that. The answer is maybe yes or no. Then, depending on that answer, it might be, can we get a new first mortgage to consolidate all of this debt? Depending on where they're at, yes or no. The third thing they're going to do is say, you know what? I can't get a second mortgage. I can't get a new first mortgage. I'm stuck with this credit card debt. I can declare bankruptcy, but I can't do that because I have too much equity in my home. So I'm going to call my real estate agent. I'm going to sell my house, pay off this $100,000 of credit card debt, walk away with $200,000 in net proceeds, and start over again. So I really appreciate your question, but no, that high-end credit card debt or that high balance credit card debt is not going to lead to a crash, but I do think it's going to lead to more second mortgage and refinance and sales transactions, which again is going to free up that lock-in effect and create a lot of opportunity for those of us on this call.
Absolutely. That's exactly how it's probably all going to work out.
Yep.
We've got time for one or two more questions too, if you guys like.
So can we do conventional loans on condos who have insurance with a 5% deductible? Yes, that is very common. 5% insurance deductible on a master insurance condo, a master insurance policy for a condo, that is no problem. 10% deductible, that's a huge problem. And we are seeing a lot of homeowners associations, and they're run by just regular people, right? And they're looking at their insurance. The insurance is going up, and they say, how can we have cheaper insurance? Oh, the insurance provider says, go from a 5% deductible to a 10% deductible. The HOA board looks at that and says, hey, we love that because now we don't have to raise the HOA dues on all of our neighbors. They move to a 10% insurance deductible. 90 days later, somebody tries to sell their home in that complex and they realize they cannot get a loan on that condo because it now has a 10% insurance deductible, and all hell breaks loose in the HOA meetings. And so then they're stuck for a while and they have to raise the HOA dues in order to pay for insurance premiums with a 5% deductible. So if you're on any HOA boards, do not let the insurance provider talk to you about a 10% deductible. That will decrease the value of your condo. So really, really glad you asked that, because we are seeing a lot of HOA boards make that error.
Well, it sounds like that might be part of why Gail's having a hard time with this condo not selling.
Yep.
Wow, you might be locked out till you can get your next annual policy, whichever you might want to ask the HOA when that's going to be. Boy, that's frustrating.
Yep. And Roxy, no, I don't recall ever saying that we could do that. If I did, I must have misspoke. But no, we cannot do a 10% deductible on a master insurance policy. It does have to be 5% or better. So I'm really glad you asked.
It's a big risk for the lender.
Yep.
Super. All right. Well, thank you guys for joining us. I really appreciate your time. Joe, thank you for joining us. And
Yeah.
always appreciate you guys making the time, and I hope you have a great night.